Hi, good evening. How's everybody? Hello.
Yeah, we're doing the
Good afternoon.
Good afternoon. Good afternoon. How are you?
Good afternoon,
Good
Professor.
afternoon, Professor.
Yeah, good afternoon. How are you making Tanya and Isora and DeAndre? All right. Um, so I believe yesterday I left you with some food for thought, right? I wonder if you ever pondered upon that question. The question was, okay, where is the I'll have to find this thing. Okay. Yeah. So we today at uh, with this question. Um, I mean, we were just about here uh, doing this example, right? Um, so the example was the Emory Corporation issued an 8% 25-year bond 15 years ago. Yeah, of course, at this point we already know that was 15 years ago. So now the time left is only 10 years. So we only need to deal with 10-year timeline. And at the time of the issue, it sold for its par value. And the question was, yeah, we know what causes the bond to be a premium bond, or what causes the bond to be a discount bond. And someone answered, it's the coupon rate. It's whether the coupon rate is greater than the interest rate or less than interest rate. And here, the interest rate I'm talking about is the prevailing market rate. Prevailing rate that is being used as a discount rate, right? Interest rate doesn't mean coupon rate is the coupon interest rate, but we understand that there are uh, many different interest rates, and it doesn't mean only one thing. When we say coupon rate, that's the interest rate the bond pays, which may be different from the prevailing rate in the economy. So a prevailing rate is the rate that we use to discount all the future cash flows to present, right? So, but at the time of the issue, it was par value. It was sold at par value. So then, what can we conclude? What can we say? What can we conclude from that? From the fact that it was selling at par value at the time. Anybody?
That the discount rate was the same as the coupon rate at 8%.
Exactly. And is this DeAndre? Hmm?
Yeah.
I believe only one person gave some thought about it. Huh? Okay, DeAndre. Um, so this is a 1 point question uh, because it involves, I mean, it's a very straightforward, simple thinking. Uh, so you got 1 point, DeAndre. Alrighty. So now, yeah, at the time, that means at the time, the prevailing market rate was 8%, and that was the only way you could sell at par value. Now, the comparable bonds are yielding 10% today. What does that mean? I said yesterday there are like three ways they say, instead of saying directly this is the discount rate, but the way it is actually worded, there are largely three ways. One of them is prevailing rate is 10%. Second, comparable bonds or similar bonds are yielding 10% today. And comparable bonds mean what? The
It means
bonds
it has to
of
be this.
hmm,
Oh, sorry. It's the
what?
if regarding this if the bond's in the same risk class. So like AAA,
Yeah,
AA.
bonds. Right. Bonds in the same risk class. Okay, that's another zero point 0.5. Uh, bonds of the same risk class. or they also call it similar bonds. Similar bonds. And the third way it is worded, is that the bond is priced to yield 10%. The bond is priced to yield 10%. And the price to yield means, if you use that discount, if you use that rate as the discount rate, right? If you use, that 10% as the discount rate, the price of the bond that you arrive at will give you exactly 10% return. That's what it means. So anyway, so it's also called yield to maturity. 10% is yield to maturity because yield to maturity is, annualized yield until maturity is 10%. And that's what. So what must Emory's bonds sell for in today's market to yield 10%, yield to maturity, to yield 10% to the buyer? In other words, then what is the price when you use 10% as the discount rate? That's what it means. So assume the bond pays interest to semi, of course, bonds are all semi-annual, right? Also calculate the bond's current yield. Now here's a new concept, current yield. So we're going to get to that later, but I already showed the model, right? The model I built to calculate it, and in this model you see bond price comes out as negative. That doesn't mean it is negative. It simply means cash outflow, right? To buy this bond, that will give you $1,000 cash inflow in the future, 10 years later, and with $40 cash inflow every 6 months for the next 10 years, this has to be paid out. So it's cash outflow, right? That's what it means. But let's do this example. Actually, let's do this example using Excel. So if you open the file in the right, the Excel file in the bond, right? The bond valuation. This one, right? If you open it, right? So you should open it in front of you. You will. I just want to. Are these blanks or highlighted cells blank? Are they blank or are they filled in? I'm sorry, there was a lot of static. It's filled in already?
Yeah.
Oh, then delete everything. Delete everything. Okay, delete all the highlighted cells because unfortunately, I didn't. Okay. Okay, and the example that we are dealing with currently is, I believe, this one. Okay, this one, 8% coupon rate, 10 years left, 10% APR. So delete all the highlighted cells. Okay, clear contents. So here, so let's do this one. And as I said, in most cases, B is the symbol I use for intrinsic value or rational price of the bond or fair value. But piece of B is the market price. And in case of bond, there isn't that much difference because as I've been explaining over and over, There's no add-up factor in bond. But market price is mostly determined by the brokers, because they do like large volume trade, quantity, large quantity volume trade. So depending on uh, uh, how large how large volume they buy or sell, there can be some discount. But here, so this is our example. You have 10 years left, so that means 20 semesters, right? Because bond is always on semi-annual cycle. Our coupon will be $40 every 6 months, right? Because it's not that difficult, annually $80 divided by 2, $40. And discount rate now, or yield to maturity. That's why it will change. This will change later. The discount rate is 10%, so semi-annually 5%. So let's find the bond price, which is then what? Payment over R minus payment over R times 1 plus R raised to N. Now, this is only the annuity part. In other words, this is only the present value of the coupon payments, and then plus the par value or the face value, right? The present value of that is 1 plus R raised to. Okay, and hit enter. We hit enter. What's going on? I hit enter. What happened? This is weird. Why is it? Why is it not calculating? The formula is correct, D8 over H8 minus D8 over H8 times 1 plus H8 raised to F8 plus A8 over 1 plus H8 raised to F8. Something's not right. I don't know. It should give you the right. This is. So if you got the something's not right. This cursor is still like this, not changing. Okay. So you will get, I believe you will get, 875, right? Did you get 875.38?
Mm-hmm.
Okay, then you got it right. Now, what is the current yield? So to explain this, I will, okay, I will need to open. All righty. So I've been telling you, yield means annualized return. So yield to maturity, YTM, yield to maturity is basically the annualized return throughout the entire remaining holding period. In other words, if you have 10 years left, right, the annualized return for the next 10 years will be whatever it comes out as. And now, according to our given setup, it is 10%, right? They say yield to maturity is also long-term yield. Long-term yield, simply because that's the annualized return for the remaining for the remainder of the holding period, which is generally more than 1 year, so long term. On the other hand, there's current yield. And what's the current yield? Current yield is current yield is what they call short-term yield. But actually, what does that mean? That's the maximum yield you can earn within 1 year. But think about it. In case of bond, what is the maximum you can earn within a year? What is the maximum can you earn? What kind of return can you earn within a year? What's the maximum you can earn?
You can earn the interest payments and the bond increasing in price.
Oh yeah. Logically, that's correct, but in the short run, unless you sell the bond, hold the bond for 1 year and sell it, right? The maximum you can earn is only the annual interest or annual coupon payment, right? So let me. The maximum you can earn is annual interest or annual coupon. If you're assuming that you're holding it for more than 1 year, but what you can earn, maximum you can earn a year, is simply annual coupon payment, right? So if you want to calculate the return, it's the price you paid, bond price, the bond price you paid, and this price is the market price, because no matter what the intrinsic value is, it may be the same thing or a completely different number. I mean, it will be mostly the same number, but slightly different. But no matter what the let's say intrinsic value is, or the rational price is $800, but the market price is $850 or $900. No matter what the fair value is, it doesn't matter. You have to pay the market price to hold it, right? To buy that bond, you'll have to pay the market price. You cannot say, oh no, this is that market price is overvalued. I'm not going to pay that. I cannot pay that overvalued. It's overpriced. I cannot pay that overpriced, overvalued price. I will wait until the price comes down. Well, yeah, you can wait until the price comes down, but in bond, if it is a discount bond, it's not as time goes on, it's not likely, it's not going to come down. It can only go up, right? If it is premium bond, it will only go down. So whether you like it or not, you'll have to pay this price. So obviously, the concept of return is what? The cash flow over initial investment. So that's the short-term yield, right? Maximum you can earn in a year. Simple concept. So it's not difficult to find, current yield. But I'm going to come back to yield to maturity, because what's more important is the concept of yield to maturity. So here, I don't know why my file is doing this funny thing. Where is it? The file is up. And my browser is slow. Oh, I didn't. Oh, no wonder I didn't close this. Yeah. H8. I'll have to close here, right? I forgot to close there. I don't know. Now, Jesus. Okay. Then the current yield is annual coupon payment is, we already know, it's it's this times 2, right? Or it was originally this times this, right? The same thing. Okay, and then you divide it by the current price, current market price. There you go. So the current yield is 9.14. Now,
Professor, I have a question.
Yeah.
So, like in real life, if we were to purchase a bond, for PB, we would just put the market price as opposed to what we calculated based on the present value formula, right? Okay.
That's right. With the formula, you find the intrinsic value, or the rational price or fair value. I mean, for finding, but for the purpose of current yield, you will have to divide it by the market price, because that's the price you have to pay no matter what, right? But in this example, I use the intrinsic value as the market price because, as I said, in case of bond, intrinsic value and the market price, the difference will be insignificant. It's not that significant. I mean, I wouldn't say insignificant, but it's not that significant. It's mostly, brokers, they're cut. Brokers will have to, factor in their, the margin there, and then there can be slight discount depending on what kind of volume trading they are doing. Now, so here, if you see, now this bond is supposed to be a discount bond. We can tell it's going to be a discount bond, isn't it right? Why? Because the coupon rate is below the discount rate, right? So in that case, right, this is the long-term yield, right, or yield to maturity. Whereas then the current yield is somewhere between. Current yield will be somewhere between coupon rate and the discount long-term yield, right, yield to maturity. Okay. So here, if I used Excel's built-in function, I can use Excel's built-in function. There are two ways you can do that. One. So here, if you use, now it's present value, so PV, right? And then you give it whatever it's asking for. Rate, You gotta, and that rate is the I believe it is the, okay, I think it is discount rate. There you go. It's a different thing when you use a different discount rate, and then n periods, n, right? And then payment. Now the payment, this is the payment, and the future value, this is the future value. Type, leave it blank, because all bonds, think about it, is ordinary annuity. No bond is, right? Annuity due. They don't pay you interest to begin with. And then close parenthesis, hit enter. And you will get it in negative because this much cash flow will have to leave you, right? To receive, these cash inflows in the future, right? But since I don't like to deal with, these negative, numbers, I mean, if you're solving for n or solving for r, these negative numbers will, using the formula, these negative numbers will cause problems. So I don't use this. Now the next example, let's move on to the next one. But before we move on to the next one, okay, what is this? You remember, before we move on to the next one, you remember that when I in the bond quotation, bond quotes in the print media, the examples were given there, and I told you the time the examples were taken was around June of 2010, and I told you how do I know? I told you I could trace it back because you can calculate n. Now think about it. This was that CIT group bond, corporate bond. The yield to maturity was 8.83, right? And it was selling for this price, right? So I simply used, I saw, I can solve it with natural log, but I simply used n period, right? So if I use, n period, n per here, right? Asking for a rate, you gotta give this rate, right? Comma, and then payment. There's the payment, comma, present value. This present value has to go in as negative. That's why I, put parentheses there. It has to, because it is cash outflow. Okay, comma, and future value. This is positive, right? Because it's going to be, and then type 0 or blank, because all bonds are basically ordinary annuity, close parenthesis, hit enter. It will give you 11.71, what? 11.71 semesters, 11.71 semesters, right? So if you turn it into then you turn it into years. Of course, you divide it by 2. Divided by 2. It's 5.86 years. So 5.86 years from May of 2016, 5.86 years back from May of 2016. So you will subtract from this. You cannot just subtract this. I mean, calendar dates in Excel is all by days. So you multiply it by 365. It's like you're subtracting 5.86 years times 365 from that date, then it will take you to June of, that's not June 10th, June of 2010. That's why I said, right? That's how I could trace it. All right. So our next. Okay, call. What is a call provision? Call. Call is a right to buy, right? So in our example, it's a right to retire the bonds early, right to buy back the bond early, right? Before the maturity. So who buys back? I said this is, a retiring bond. Who retires bond? Who, in other words, they redeem the bond, retire the bond early. Who? So who? So they're buying. So who's retiring? Of course, the seller, issuer of the bond, issuer of the bond. Now here's the so where is the? I guess you can. Big. Now we have to make a distinction between the seller, bond seller, and bond issuer, because, okay, issuer and seller are not necessarily the same, because bond issuer is the company, right? Company sold bond, but the seller is not necessarily the company. It can be, it may or may not be. So think about it. In the first round of sale, in other words, when the bond was first issued, when the bond was born, the seller is also the company, because the company is selling the bond, right? The first round of trading is called first round of sale. First round, where the first bond is first sold, is called primary market. Primary market, right? And then after, so in the primary market, the trade transaction happens between the company and the buyer, right? But after that is all called the secondary market. After the first round, second round, third round, after that is called secondary market. So secondary market means, and in the secondary market, it's all between the investors. Isn't that right? The guy who bought the bond in the first round in the primary market will be the seller, right? And then, so how many rounds go on? Like there can be n rounds of transactions, n rounds of trading. It's all called the secondary market. This concept is the same thing also in the stock market. Primary market is when the stocks are sold for the first time, and there's a name for that. It's called IPO, right? Anybody heard of IPO? Initial public offering, right? The company is offering stocks for the first time to the public. So initial public. IPO is the only primary market. After that, it's all secondary, right? So only in the primary market or IPO, the transaction is between the company and the investor. But after that, it's all between the investors, right? So primary market exists only once in the life of the security. After that, it's all, it's just almost like it's like the marriage, there's only primary market. There's only in marriage, the first marriage is the primary market. After that, it's all secondary market, or then also the concept of when we say bond seller, you have to distinguish. Does that mean the issuer, or issuer is the company or treasury or the municipal government, or is that the dealer, broker, or the other guy who at the other end, the other guy who's actually selling what he has been holding. So you have to make that distinction. And then, so call means the issuer. Issuer is retiring the bond early, right? So in other words, it's like they are recalling the bond. The issuer, the company is recalling the bond. Then it's early retirement of debt, right? It's early retirement of debt. And you might wonder, is that possible? I mean, can they do that? Yes, of course, they can do that. They can do that. But not every bond is callable. Only the callable bond is callable. Right? Only the callable bond can be called. So when the bond is sold, you have to read carefully if it is a callable bond or not. Indenture. This is the indenture bond. The bond sale agreement is called indenture, and in the indenture, everything is everything is very detailed. Everything is detailed. Whether this bond can be called or not called, in case of stock, something similar to indenture in bond is called prospectus. Prospectus, explains everything about what is the dividend, payout ratio, and et cetera, et cetera. In indenture, of course, it says, what is the coupon rate, blah blah. What is the term of the but so if the bond, why do they call the bond then? Why do they call the bond? In other words, why do they retire early? There is only one reason why you would retire the bond, the debt early. Put yourself in that position. If you are a borrower, you borrowed $1 million, let's say. You borrowed $1 million for 10 years at 10% interest rate. You borrowed 1 million at 10% for 10 years. Now, 10% is obviously a huge burden. Why? Because annually, that means annually interest alone is already something like $100,000. $100,000 annually, right? That's crazy, isn't it, right? It's a huge burden. I mean, for an individual, it's somebody's annual income. I mean, it's a good income, right? It's almost like twice. It's not exactly twice, but U.S. Average, per capita GDP, per capita income of U.S. is about 60,000, somewhere around 60,000, give or take few thousand, 60,000. So $100,000 is almost 1.75 1.8 times the average per capita GDP of the U.S. Right? Somebody's annual income. And in upper side, right? It's a huge burden. Now think about it. You're gonna have to pay this, $100,000 for the next 10 years annually. That's already backbreaking, right? It's already backbreaking. So then, what do you wish for then? If this is the situation, what do you wish for?
You wish for lower interest rates.
Yeah, you look for lower interest rate. And if it is possible, so if the interest rate goes down to 5%, that will be wonderful. But you might wonder, well, how? I mean, even if the interest, this 5% interest rate means prevailing market rate, the market rate is going down 5%. But this 10% is locked. Think about it. When you borrow money, when you get a loan, don't you think this rate is locked? The rate is locked. Of course, there is adjustable rate or adjustable rate mortgage or floating rate, which makes it more difficult because why did in the first place 2008 actually why did the financial crisis take place? Why did it break out in 2008? Actually, it was started with the subprime mortgage crisis in 2007. In September of 2007, I still vividly remember the Fed raised the interest rate by about 5%, just within 1 year, and then September, subprime mortgage crisis broke out. Why? Because there were so many people, right? So many people who didn't qualify for any loan, who are called, basically then in all categorized as subprime category, all categorized as subprime. Subprime sounds like just below prime. No, actually prime is good. Your credit score is very good if you're prime. Then subprime sounds like, if it is not good, it's just below it, so it's probably average. No, subprime actually means very, it's a euphemism. You understand? Euphemism. It's just putting it in a nice way. But subprime category borrowers were people who had very, very mediocre credit rating, very mediocre credit score. But then they could still get the mortgage, I mean, to talk about it is a long story. In early 2000s, the housing market was booming. Housing market was booming because the banks had, banking sector had was loaded with money, a lot of money. And that money was mostly from China, because China ran a lot of trade surplus against U.S. throughout 1990s. So when they ran a lot of trade surplus, they received that trade surplus, payment for trade surplus in dollars. And when they received the dollars, what did they do? They didn't repatriate it to China. They didn't take it to China. They left it in the U.S. They put it into the U.S. banking system. They put it into U.S. Treasury. Why? Because that's the safest investment. You understand? That's the safest investment. Now that always happened because in 1970s, Japan ran a lot of trade surplus against the U.S. So then when they got paid, and in international trade, only 5 key currencies: U.S. dollar, British pound, and then now it's euro, and there is Swiss franc, and then there is what else? Japanese yen. But before euro, there was French franc, or Deutschmark. Now it's euro, Deutschmark. Now it's euro. So think about it. International trade, most preferred currency payment for payment is US dollars or euro, right? And then everyone, even China, they want to receive payment in US dollars or in euro, right? Now, normally if you receive payment in dollars, country like South Korea, when they were developing, when they export to foreign countries and receive payment in dollars, they used it to import capital goods. Of course, to import capital goods, they don't have to. It will still be paid out, in dollars, so they don't need to repatriate it. They don't have, but they can keep it outside. But countries that have relatively strict currency control will require that payment to be repatriated, because you earned that and you need to use that. Because if you sold something, you receive payment in foreign currency, you have to bring it back home and convert it into home currency, so that you can pay with that money. You can pay your employees, you can pay for the raw materials, you can pay your vendors, and etc. etc. But if this is basically taken care of already, whatever is surplus, you leave it in the foreign banking system, especially U.S., because that's the safest place to park your money. So back in the 70s, Japan ran a lot of trade surplus against U.S. So then, of course, some of it they repatriated. They brought it back to Japan. Turned into their own current Japanese yen, and then, but some of it was, still retained in the U.S. banking system. So that's why in the in the 80s, Japan was able to buy a lot of U.S. real estate, Pan Am building. And then in the 80s, it's the Saudi oil dollars, right? All those oil dollars. I think that it was a little switched. I think it is probably 70s. That was oil dollars. A lot of Saudis actually lived in the USA. They had their money. Those oil, and the wealthy Saudis are all related to the royal family. If you are not somehow related to the royal family, you wouldn't be. And then the oil dollars were all held in the U.S. And some of you may have already seen that picture. In the 70s, all of Bin Laden's family, his siblings, his cousins, everybody was living in New York City. They lived large, and in the 70s, the cars were, huge. Cadillac, Fleetwood, I think the big Cadillac convertible. It's the size of a the length and width of Cadillac convertible was the size, almost the size of what should I say, full size van, with van were the 12 passenger van, the full size van. And it was just on four wheels, convertible, and all of those Bin Laden's siblings and cousins all fit into that big pink Cadillac. So that was, what was happening in the 70s and 80s. Japan that ran a lot of, trade surplus, parked their money in the U.S. And then, in the 90s, China ran a lot of, trade surplus. Then they parked all that money in the U.S. banking system. So U.S. banking system was awash with, a lot of dollars. And what do they do with that? Banks must lend that money, right? Isn't that right? I've been telling you, banks make money by lending money. But early 2000s there was a slight recession, and the economy was because at the end of 1990s, the dot-com bubble bursted at the end of 1990s, so early 2000, and then there was even a movie called Y2K, and there was a lot of this bogus scare about year 2000. So maybe you can still look up that movie Y2K, and that was about in year 2000 disasters will strike, all the computers will reset to 000, and the planes will fall from sky, and because they're onboard computers, flight onboard computers will malfunction or act up, and the planes will crash, and there will be a global earthquake, and meteorites will hit the earth, and that because, and it was already predicted in the Mayan calendar, doomsday, and all that Y2K phony bogus. But one thing happened, which was, dot-com bubble bursted, right? Dot-com bubble, bursting of dot-com bubble. And after that, the economy lost steam. And since the economy lost steam, the banking sector had nowhere to lend the money to, right? Then, as a substitute, real estate market came up. Why? Because if you lend to the think about it, real estate market, it's mortgage. Mortgage means what? The houses. This is a safe lending because the properties that are purchased with the mortgage loan are automatically self-collateralizing. You understand? They are. When you take a mortgage loan, the house that you buy is already put up as a collateral. So if you fail, if you default, if you fail to pay, if you default, then the bank will simply repossess the house and they will resell it, right? They will sell it off and then they get the money back. Until then, so that was why there was a housing market boom in the early 2000s, right? So the banks were in an all-out competition. The banks were in an all-out competition to increase their lending, because the more they lend, the more they make. And so they were even lending out to the subprime category people who didn't actually qualify for any mortgage. But then these people were on adjustable rate mortgage, which is basically floating rate, not locked. Okay, but then this works. I mean, this is okay as long as the interest rate is low, right? Or interest rate goes down. It's okay. But when interest rate goes up, they can no longer hold up. They can no longer hold up. That's why when in 2007 when Fed raised interest rate by almost 5% over in one year period, a lot of these defaulted. A lot of these defaulted, right? Like a domino. So the banking sector was going down, like banks were going down. Think about it. They cannot recover. once this happened across the entire economy, so they foreclose, they repossess all these properties, and the banks will want to get rid of these foreclosed properties, but they cannot get the fair value on it. Why? Because there are so many properties suddenly in the market. The prices will be held. In other words, they cannot recover their loan. They cannot even recover the half of their loans, right? Normally, ordinary time, if they sell off these repossessed properties, they can recover their loan. They cannot recover their loan, right? So that made all the banks, some banks may go bankrupt, and all the banks were on a very tight control of liquidity. In other words, they wouldn't lend. They stopped lending. I mean, this is not the time to lend. They have to all recall the loans if there are, they must hunker down. They have to grab everything. So all the loans dried up. It's called credit crunch, right? As the loans up, low cash flow in the market. Low cash flow means low liquidity throughout the economy. Low liquidity, low money supply means economy will shrink, right? That's what happened in so that's what happened in 2007 through 2008. Okay, now that took us that took us off the course for quite a while. It was a digress, but the point is, although there is adjustable rate, but most of the times, if you get a loan, right, at 10% for 10 years, this is locked, right? So it's a huge burden, and you are hoping for, if the interest rate goes down, then it will be wonderful. But how? Even if the interest rate, prevailing market rate, goes down to 5%, your loan is already locked at 10%. How will this help? Ever thought about it? Your interest rate is locked with 10% for 10 years. It cannot change. It cannot come down. Then how would this help? How will the market rate going down to 5% help? Anybody ever thought about that?
Yeah. So after a certain number of years, regarding the call protection, they'll refinance at that point when they're able to reach that 5% rate.
What call protection? What does call protection have to do with this?
So you said how they get to 5%. So like after a certain amount of years, depending on the bond, they can refinance to reach that 5%.
Oh yeah. Look, refinance. That's the point. You can refinance. That means what? Okay, so DeAndre, I'll give you 1 point for that. I wish everyone would be like DeAndre. I think DeAndre is studying very hard in advance. Is watching all the YouTube videos. I mean, the pre-recorded videos in Blackboard. Some of them already passed, some of them are still active. But if it is already passed, you can't see it anymore. But then I gave you my YouTube channel. You can always whatever is already grayed out, whatever is already no longer visible, you can always watch it on YouTube. I mean, if you're it's only a matter of studying in advance, right? If you study in advance, so what is refinancing? Refinancing means don't think about the company, don't think about the bond, but if you borrowed money, let's say you borrowed money, you got a mortgage loan, and $1 million mortgage loan at 10% for 10 years, and the 10% is such a burdensome rate. But after a certain number of years, let's say market interest rate went down to 5%. What can you do? You can apply for a new loan for 1 million, right? But this time, your new loan can be at 5% because market rate has gone down, and as long as your credit score is relatively decent, you will get it at the prevailing market rate. So if you're getting a new loan, right, at $1 million, you got a new loan of $1 million. With that $1 million, what do? You pay off the old bank, right? Makes sense? You pay the old bank. You pay off the old loan. You pay the old bank the principal of 1 million. Then your connection with your relationship with the old bank is over. That's done, right? Now you are starting a new relationship with the new lender at a low 5% for the remainder of that period. I mean, if if this happened in year 4, right, for the remaining 6 years, you will be paying 5% interest for the remaining 6 years, right? Or whatever, 10 years or whatever. You can extend it to 10 years. But you paid off the old lender. Make sense? That's refinancing. That's the basic concept of refinancing, right? In reality, you don't even have to bother with, when Bank A, this is your old bank, and there's Bank B, that's your new bank. With the old bank, your interest rate was 10%. New bank, interest rate is 5%. So when you refinance, you don't even have to get the loan and pay them. You can make your new bank directly pay your old bank, right? You don't have to. Why? And you probably also have seen on a small scale, you may have received, you didn't ask for it, but sometimes you get this mail from the bank, some bank or some credit card companies saying that use this check. They send you a check. Use this check to pay off your old, right? Bank B sent you this check in mail, and then it says, interest rate 5%. Use this check to pay off your old whatever existing loan. Then by using this check, you write this check, and on this, here, you write $1 million and send it to Bank A, right? Then what is that? Bank B will pay Bank A $1 million, and from there, from that point on, you will be Bank A no longer your bank. Bank B is your bank now, and you will be paying 5% to Bank B. This is refinancing, right? So then, what does it have to do with our coal? Again, coal. So I guess it's a good time to take a break at this point, and so we'll take a 10-minute, and when we come back, then we'll continue, right? Alrighty. So let's take a 10-minute. Okay. All right, we're back. We're back. So we're going back to okay. So the coal, right? So so actually, coal is um, so I'm not going to go more into that, but coal versus put. I mean, it's actually coal is originally uh, coal and put are options, right? In the stock market, because uh, coal is an option to buy stock at a pre-specified price. Pre-specified. Put is an option to sell the stock also at pre-specified price. So of course you have to pay. You have to pay for the coal. So um, let's say you don't. Let's say you have, let's say Google stock, and currently it is like $123. Let's say you're gonna sell it. You will sell it if the price goes up. If the price is 130, you want to sell it, right? Uh, However, you don't know. You don't know. I mean, it looks like the price is, pretty much, it's gonna go up, but who knows? I mean, price is always fluctuating every day. Instead of, but when the price may be actually, not going up, but it can go down to something like 110, right? If it goes down to 110, right? Obviously, uh, you're gonna wait for the price to come back up. But let's say it's gonna stay at that low uh, level for quite a while, right? Then you will regret because you missed the timing, the right timing. I mean, you should have sold it when it was 123 already, because it never happened. I mean, this 130, it never went up to 130. So you should have, but currently the price is 110. So you regret. So what do you do? That's what the call comes in. In this case, that's the put. It's the put. Um, you should have. Uh, but if you wanted to buy, the currently is 123, but you think it's going to go down. But if it doesn't go down, but it keeps on going, it keeps going up, then what do? You will regret not having taken action when it was 123, because it never went down. It keeps on going. Uh, so then, to have Google, you will have to pay 130. There's no other way. But there is an option. There is a way. If you buy call option may be about $5 or whatever. Um, so then, even when the price goes up, this call option gives you the right to buy Google for 123 or 125, whatever the pre-specified price is, right? And put is the option to sell at a pre-specified price. So of course, comes it's not for free, and it's the same thing. I mean, when it comes to bond, right? Call option in bond is the right to buy back. So this applies, call option applies to the issuer, right? Issuer can buy back, and it will happen. They want to buy it back when the condition is right. Then what is the condition? The prevailing market rate dropped, right? This is a refinance opportunity, so that's when they exercise, that call option, right? So it's this, it's in the same vein as in the stock option, the option for call option for stock, and the but as I said, not all the bonds are callable. Only the call bonds are callable. I mean, there are bonds that are born as callable bonds, right? That's why you have to read carefully the. And if this happens, if the bond is called, who gets the hit? I mean, who suffers? I mean, who loses?
The initial lender.
Say that again. There's a lot of static.
The lender takes a hit.
The lender, yeah. The lender or the bondholder. Bondholder suffers, right? They lose money. What? Because suppose the maturity of this bond is 10 years, but this is a callable bond, right? 10 years. And let's say in year 6, the bond is called, right? And of course, the lenders knew, they should have known that this is a callable bond. And 1, 2, 3, 4, 5, 6. And then that means, until then, they were getting 10% interest every year, right? 10% every year. But from year 6, nothing. They got their principal back. In other words, they got the face value, right? They got face value of 1K plus just one more year coupon, one more year, 1 year. So 1 more year coupon is called, call premium. And call premium means, it's like early termination penalty, right? Early termination penalty. But think about it. If the company can save, I mean, for paying just 10% one more, for 1 more year as penalty, but for the remaining 3 years, they will be saving interest, right? They will be paying only 5%, so they save. Now, so this is, so think about it. From the lenders are not in good position when interest rate goes down. The bond is likely to be called. Lenders will lose money, and once the interest rate has gone down, average market rate has gone down to 5% on average, right? There is no bond that will pay 10%. I mean, the bondholders or the lenders will be missing out. There will be no more opportunity to earn this high interest rate, right? That's called, that's called reinvestment rate risk. Reinvestment rate. In other words, the lenders will, when overall interest rate in the market goes down, the lenders will lose the opportunity to earn high interest rate anymore. That's because they cannot reinvest. Think about it. They got their 1K and they got 1.1K, right? They got 1.1K because the face value of the bond and $100 called premium. So 1.1, but they cannot reinvest it. This money cannot be reinvested anymore in 10%, anything that pays 10%, because there's no more anything like that. Overall interest rate in the market has gone down, right? That's why it's called reinvestment-linked risk. Um, but again, because lender is at risk when the bond is called, generally there are two things that will that they use to mitigate, two that are in place to mitigate this shock to the lenders. One thing is call protection period. So let's say for the first 5 years, it can be any number of years. I mean, if the maturity is 10 years, for the first 5 years, you cannot call, right? You cannot call. So even if the interest rate goes down, you cannot call, right, for the first 5 years, or maybe for the and then after that, year 6, 7, 8, 9, 6, 7, 8, 9. Think about it. Nothing happened in the first 5 years, and let's say in year 8, interest rate went down. In year 8, interest rate went down. Now, does it make any sense? I mean, by this time, will the company call the bond?
No.
No. When you are close, very close to the maturity, right? It's even if it is, I mean, the savings. I mean, what is the benefit of recall? What is the benefit of calling the bond? Benefit of calling the bond is the interest saving, right? But if it is year 8, at the end of year 8, the bond interest rate went down, then they will save only through, year 9 and year 10. But then one more year, they will have to pay, 10% call premium. So the saving is only for 1 year. I mean, if it is still worth it, I don't know, for whatever it is worth, they will. But, the closer to maturity is less likely to get called. Okay? Makes sense? Alrighty. So that's a lot about, that's what the call is. Where was the... Okay. And if you are valuing a call bond, right, you only need to remember two things. First, and if it is, short to be called, valuing short to be called bond, now, think about it. This is 10-year bond, and call protection period is up to year 6, right? And now we are at the end of year 2. So valuing this bond, we don't use year 10. So year 10 is like eight years left. We don't use 8 years for timeline because bond can be called in year 6, and after that, you cannot. After that, you cannot use the same discount rate. You cannot, and the payment won't be. Basically, so for a bond that is going to be called, that's sure to be called, you use only end of the call protection period as the timeline. So then we have how many years? 1, 2, 3, 4 years, or 8 semesters, right? So we only use that 4 years as the timeline, and we add call premium. So basically, at basically, at the we make adjustment to the face value. I mean, we discount because at the end of year 6, which is 4 years from now, you will receive 1,000 plus one more $100. That wasn't originally there, right? So this one will be 1.1K, right? Discounted 4 years back, right? That's call premium is because call premium is added to the face value. Okay, and then if it is not callable bond, of course, the normal valuation you use all 8 years timeline, and the more the closer we get to the maturity, the more unlikely it is going to get called. Okay, so here let's take a look at this example. I don't know if if you have time to do this or not. The Northern Timber Company issued a $1,000 2-year, 25-year bond 5 years ago. That means we have 20 years left. The bond has a call provision that allows it to be retired anytime after the first 10 years. So, call protection period is the first 10 years, but the 5 years have already passed. So we still have 5 years left in the call protection period, right? Makes sense? Of course, there's one additional year's interest. Interest rates were especially high when the bond was issued. Yeah, if interest rate was high, there will be a lot of callable bonds. And its coupon rate is 8%. Oh, 18% coupon rate is really, really high. It's almost like 20% a year. Isn't that right? Not even stocks. There aren't that many stocks that give you 20% return a year, but this bond is almost paying like 20%. Very obviously from the company's Northern Timber's perspective, this is really backbreaking, isn't that right? Interest rates on the bonds of comparable risk are now 8%. What does this mean? That's the discount rate, right? 5 years ago, it was very high, but currently interest rates went down, so discount rate is now 8%. What is the bond worth today? What would it be worth if it didn't have the call feature? So we can, simply with a call price, price to call, right? We have. It should be 5. I made a mistake here, right? Because call protection period is 10 years, first 10 years, and the bond is already 5 years old, so we have only 5 years left, right? So then the T will be 5, N will be 10, right? At this point we have, but it was like, it was calculated as if we are at time 0. Now we're at time 0, we are at time 5, right? So here, let's see how we guess. And the second, if it is valued as regular, right, a non-callable bond, a regular bond. So let's go back to. I don't know which example. I can use this as the example. It's not the same thing, so I'll just insert. I will insert. So I want everyone to do this with me. Do not just watch it hands down. Your hands must be also busy, right? Do not watch it just hands down. Do this with me. So first, if we treat it as callable bonds, right? Everything else should be, ignore this. Now, coupon rate is 18%. That C means, coupon rate. And then semi-annual, right? And time left to end of call protection, 5 years. But if it is a normal bond, you still have like 20 years left, because we're at the end of year 5, and the bond was, had 25 years. So this will be 20, right? And then currently discount rate is 8%. I'll make it equal to. And then, so what you need to do is, okay, this is fine. And then I will simply need to make this 1 more year, right? So what is this? At the end of the call protection period, right? $1,000, right? Times 1.18, because you have 18%, additional coupon payment paid as, call premium, right? That needs to be discounted, back 10 semesters, right? So that will, and if you hit enter, that will get you 1,527, right? 1,527, which is, think about it, which is, that's a premium bond. That has to be a premium bond. Well, who pays 18%? And the discount rate is way above, way above, right? So even with only 5 years left, it's worth that much. Now, if it is just regular bond, not callable, 18% goes on for 20 years, right? Currently 8%. It will have to be valued this high, right? It will have to be valued this high, right? This one is, of course, there's no, it's just regular 1,000, right? So everyone got the same result?
Yeah.
Okay, good. How about the other people? How come it's always just one person? How come? How about the other people? Did you?
Yeah, makes sense.
Okay, good. I want you to actually, do this exercise. You need to complete it. And if you have watched me, what I'm doing, if you manually input all this all over again, if you manually input this all over again, then that's not very smart thing to do. What I did was I just simply inserted. I inserted one more row, right? You can insert one more row, right? Insert, just select, this. I selected this row, and insert one more row, and it inserted one more row. And then all you need to do is just copy and drag it down, right? Highlight, and just make some necessary adjustment. Copy and drag it down, and make some necessary adjustments. And when you drag it down, it will automatically add 1. So just and then if it adds 1, this is going to be 118%. So just I made it equal to that, made everything equal to the previous one, but this one I had to make it 20, and then everything adjusts automatically. You don't have to do it all over again. Formula is formula. It's just same formula here. I just made adjustment to the formula to this one, but before making adjustment, This formula was already like that, so it's going to automatically adjust. Alrighty, so that brings us to okay, so that's the one. That's that example. Um, we got the same result. This one, I told you that this one is uh, incorrect because this has to be 5, not 10, right? Okay, so and this is something you can just read about. Now, so we realize here that the bond prices will depend on the discount rate. And the discount rate is the prevailing market rate. Prevailing market rate actually means uh, the average, average coupon rate or average yield of the bonds of the same risk class, right? Some, because prevailing market rate cannot be just a blanket rate. I mean, it cannot be just neutral blanket rate. Why? Um, it's not a bank interest rate. Why? All bonds have different risk class, and depending on the different risk class, the interest rate would be different, right? So it cannot be a neutral blanket rate. In other words, the discount rate cannot be a neutral blanket neutral rate. So when we say, although the wording is prevailing market rate, the prevailing market rate means the rate that is prevailing for that risk class. That's what it means, right? And we understand that because it's the present value, and we understand the nature of present value, the relationship between the present value and the interest rate. As the interest rate goes up, the present value goes down, right? And as the interest rate goes down, the present value goes up. Now, this is no secret. Valuation of any asset, any financial asset, valuation, stocks, bonds, low interest rate is better for the bond or stock. Stock market, low interest rate is better. Why? The valuation goes up, right? Now, why were they, talking about recession, and why there was such a fear when, before, a July Fed meeting, there was a lot of scare about, oh, the Fed will take a big step. What does that big step mean? Big interest rate hike. And then the market shrinks. Suddenly, stock market all freezes over. Why? They all sell. The stock market falls because they all sell before the price falls any further. They fear that when Fed says interest rate is now they're going to raise interest rate by 2%, they will all it will freeze like hell because they are anticipating that kind of press release, that kind of guidance from the Federal Reserve. And if that's the case, then they will all want to sell before rate goes up, because once the rate goes up, the valuation goes down. So they want to sell before their stocks are valued lower. So when they sell, it's a self-fulfilling prophecy. If you sell, the price will drop. If there is a massive selling, the price will drop. The market will go down, right? But a good thing, the Fed couldn't take a giant step, right? So we see there's an inverse relationship. Clearly, there's an inverse relationship between the interest rate and the bond price. This interest rate means prevailing rate in the market, right? Of course, when Fed funds rate goes down, all the rates go down, right? Look, when the interest rate was this high, so for interest rate, you gotta look at the right axis. right vertical axis. For the bond price, you got to look at the left axis. You understand, right? You cannot look at this interest rate and look at this left axis. And obviously, you don't know what interest rate that is. I mean, that's price. So if you look at that right axis, interest rate is almost like 15%, more than 15.5%. Wow, was there ever a time when interest rate was that high? Yes, 1980s. I've been telling you. Early 1980s, I've been telling you, interest rate was like 15%, and then the market froze over. It was a recession, 82 through 1982 through 1984. It was the benchmark recession time in the recent history. And in those days, bond prices. Look at the bond prices. Par value is 1,000. It is like 800. And not only the bond, stocks would also freeze over. And then as the interest rate went down, when interest rate was like about 4%, and the bond prices were like 1,600, and then interesting thing is the bond interest rate went down and down. This is 2009, 2008, 2007, 2007 through 2007 through 2008. Interest rate went down almost 5%. Right? Interest rate went down. Why? The Federal Reserve had to lower the interest rate to stimulate the economy. And then when that happened, then if the interest rate is low, then the bond price should go up. But actually, bond price didn't go up that much, but it didn't go below the par value. But why? Think about it. This is the recession time. During the recession, right? Nobody's investing. During the recession, nobody's investing. The price has to come down. But one thing is for sure, the relationship is inverse. There's an inverse relationship, right, between the interest rate and the bond price. So this was, this is also called interest rate risk, right? You know what interest rate risk is. Remember when we did in the topic one, in topic one, four types of risks about bond, right? I wonder if you remember one. Of course, the highest, the most relevant, most immediate risk is the default risk. Isn't that right? Because it's the greatest risk surrounding a bond is the default risk. But this is a borrower specific, right? The company specific. Then there is inflation risk. Three, liquidity risk. Fourth was maturity risk. But the maturity risk is also called interest rate risk. Interest rate risk. Why? Why? Because the longer the maturity, the more the uncertainty about the interest rate. We don't know how the interest rate will behave in the long run. And if the interest rate goes up, the valuation price suffers, and the longer the maturity, there are more chances of interest rate fluctuating, right? Especially if it is going down, then it's not a risk. If it is going down, it's not a risk for it's a it's still a risk. It's called upside risk, because if interest rate goes down, valuation goes up. So you might wonder why is it a risk? Uh, it's a happy news, right? If interest rate goes down, valuation goes up. So it's a pleasant surprise. But even the pleasant surprise is the risk. Why? Any uncertainty is risk, because risk is not only the downside, upside is also uncertainty. Therefore, it's the risk, right? And also, maturity risk is also called, I told you, interest rate risk, but it's also called price risk as well. Price risk. Why? Because price will fluctuate. If interest rate goes up, price will go down. And the longer the maturity, the greater the chance of price fluctuation. So, hence it's also called price risk. Okay. Now the interesting thing is, I told you, it's understandable, but there is also something called reinvestment rate risk. Reinvestment rate risk. And I explained it. This is, you understand, interest rate risk happens when interest rate goes up, right? If interest rate goes up, then everything suffers. However, when interest rate goes up, you benefit when you reinvest. Whatever the dividend or interest, you can reinvest everything at a higher rate because overall interest rate in the market has gone up. So this is a pleasant surprise for reinvestment, for reinvesting. But when interest rate goes down, right, this is a pleasant surprise for the investors. But for reinvesting, this is a bad thing, because you will, especially when the bond is cold, you cannot reinvest it no longer at higher rate anymore, because throughout the entire economy, everything pays lower rate. Okay, does that make sense?
Yeah.
Yes.
Okay. Okay. Good. So where was I? So it's basically what it is saying, and this is okay, when you can forecast the and forecasting the interest rate in the short run is not that difficult, because Federal Reserve always gives guidance. Long run, forecasting long run, that's the difficult story. So I guess that's all the time we have for today. I have just about a few minutes left, so let me end with this note. So when I was an undergrad student, and as an undergrad, I was just liberal arts major. So it was such a, I didn't understand anything, but in those days, Bloomberg News, or, there was, financial news, there was no CNBC at the time, no CNBC, no CNN. CNN came around. They covered, financial news only in mid to late 1980s. So when I was an undergrad, there was nothing like it. But there was Bloomberg and Reuters. And in the news, when they are talking about the market, they always say interest rate is down, bond prices are up, or bond market is up. Interest rate down, bond market's up. Or sometimes they say interest rate is up, the bond market is down. Now, as an undergrad, I couldn't make this out. I couldn't understand this. When I studied economics as a graduate student, then it made perfect sense. But as an undergrad, I had no econ background or anything. I never took any econ as an undergrad. But to a layperson, who doesn't know anything about interest rate going up, sounds like a good economy. Isn't that right? Huh? Doesn't it sound? If you are totally ignorant of anything like economics, you have no knowledge of economics. If interest rate goes up, it sounds like a good thing, doesn't it? Because if you put your money in the bank and if interest rate goes up, that sounds like a good thing. That must be a good economy. But then the anchor says interest rates are up, bond market's down. So why is the bond market down? I mean, if interest rate is up, isn't that a good thing? Why is the bond market down? Now you understand why. Because there's an inverse relationship between the bond price and interest rate. And when interest rate is down, that sounds like a bad economy. I mean, I put my $10,000 in the bank and I get lower interest rate. I get lower interest, smaller interest. That sounds like a bad economy. But then they say interest rate is down, the bond market is up. Why is the bond market celebrating? Why is the bond market jubilating over, low interest rate? As an undergrad, that was a mystery to me. But now you should know, you understand why, because of this inverse relationship, right? And this inverse relationship is something that sets apart the econ finance majors from liberal arts majors, because liberal arts majors they think if anything goes up, that your impression is it must be a good thing. But actually, it is not. Why is the bond market going down? The liberal arts majors will never figure out, right? But you know why, okay? All righty, so that's all the time we have. If you have any questions, just email me. If you want office hour with me, email me. That's the only way. Okay. Have a great evening, everyone, and I will see you tomorrow. Okay? All right.
Thank you, Professor.
All right. Good night.
Good night.
Good night. Good night. Take care. So.